Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Now, what do you think of this portfolio of 20 companies? I have blurred the names of the companies to avoid any sort of biases. None of these 20 companies have good fundamentals if you ask me. They have each made losses in the last 5 years and either have a negative net worth or have debt on the balance sheet that is much higher than equity. So, a fundamental investor would like to stay as much away from these stocks as possible. Now, how do you think an equal weighted portfolio of these 20 companies would have performed in the stock market in 2024? Yes, that's correct. You need to guess the performance of these stocks as a portfolio in 2024. Well, let me break the suspense. An equal weighted portfolio of these 20 stocks would have earned 40% returns in 2024. That's true. A 20 stock portfolio of some of the worst companies fundamentally would have done much better than the nearly 30% returns earned by the BSE Small Cap Index. In other words, a portfolio of fundamentally bad companies would have outperformed the BSE Small Cap Index by a significant margin in 2024. Before we move further, let me reveal the names of these stocks to you. Here they are. Yes, this is the portfolio that has given the BSE Small Cap Index a convincing beating in 2024. There are some famous names here and some not so famous. Let us move a year back to 2023. Again, similar performance. A 20 stock portfolio of fundamentally bad companies had again outperformed the BSE Small Cap Index in 2023. In fact, this time the performance was even better. A portfolio of fundamentally bad companies was up a whopping 75% as opposed to the 47% returns given by the BSE Small Cap Index. What exactly is happening here? Aren't we told to stay away from fundamentally bad stocks as these stocks are toxic and can harm your portfolio? Should not we only invest in fundamentally strong companies as these are the ones that outperform the benchmark index and lead to long-term wealth creation? Well, before we conclude that it is better to invest in a group of loss-making and weak balance sheet companies as compared to fundamentally strong ones, we will have to look at a longer-term data. We will have to look at a 10-year period at least to see whether a portfolio of toxic companies, as I like to call them, does indeed outperform a portfolio of strong companies or the benchmark index for that matter. So let's check out if this is really the case. Here's what I did. I picked 20 toxic or fundamentally weak stocks at the start of the year and held them for 1 year. Then I picked 20 new stocks with the same characteristics and so on. I made an equal weighted portfolio of 20 stocks. The stock qualified as a fundamentally weak stock if it had made back-to-back losses in the last 5 years. The more, the merrier. And also had a negative debt to equity ratio or a debt to equity ratio of more than 1 times. The stocks were also required to have a revenue of at least rupees 200 crores or 2 billion for the latest year and an average daily liquidity of rupees 1 million or rupees 10 lakhs for the last 1 year. We are now ready to sit back and watch the performance of this toxic or a portfolio of fundamentally weak stocks unfold. Here's the year-by-year performance of this portfolio over the last 10 years, that is between December 2014 and December 24. As we can see, although the portfolio of fundamentally good companies portfolio of fundamentally bad companies has done very well in the years where the benchmark index has done well, it has done very poorly when the broader market has had a bad year. The year 2018 and 2019, when the BSE Small Cap Index had crashed, the portfolio of toxic stocks had crashed even more badly. In these 2 years combined, it had lost almost 80% of its value. So in a bear market, investors really dumped these shares left, right and center and literally ran for the hills. Hence, cumulatively over a 10-year period, the toxic portfolio significantly underperformed the BSE small cap index and gave a CAGR of just 10%. In contrast, the BSE small cap index achieved a CAGR of 17%, turning every rupees 100 into rupees 500, as opposed to the toxic portfolio, which turned every rupees 100 into only rupees 270. The verdict is quite clear. A portfolio of fundamentally bad companies, or toxic stocks as I like to call them, can outperform in a bull market and perhaps even by a wide margin. However, the wealth destruction in a bear market is so huge that it cancels all the good work done in a bull market, and net net the portfolio ends up as a big underperformer. This is quite clear in the 10-year study we just conducted. Therefore, if you're keen to invest in a portfolio of fundamentally bad companies in the hope that you will end up with market beating returns, do so at your own risk. Of course, you could do well in a bull market and the outperformance could encourage you to put more money into this strategy. However, it could end up being a terrible mistake. All the wealth that you had generated in a bull market could go up in smoke in a bear market, and you may end up with a significantly below par performance. Investing in fundamentally bad companies is something I would totally not recommend to anyone. By the way, take a look at this portfolio of 20 companies. These are fundamentally some of the worst companies, as they not only have a negative net worth, but they have also recorded losses in each of the last 5 years. Now, this portfolio is already down 20% in 2025 so far, as compared to the 18% decline in the BSE small cap index. Therefore, it is already performing worse than the benchmark index. So, if you are expecting the markets to correct further and the small cap correction to get worse, I recommend that you stay away from these stocks and stocks with similar characteristics as much as possible. You see, there is investment and then there is speculation. Investing in fundamentally weak companies or toxic stocks can't be called as investment, to be honest. It is speculation at best, and you should avoid speculation at all costs. You can do it with just 5% to 10% of your total corpus if you want, but never invest any serious money in it. For as we saw, the end result of speculation over the long term is either wealth destruction or very poor returns. Therefore, while fundamentally poor companies can give you good returns for some time, the end is nearly always painful. So stay alert and stay away from toxic stocks. I'll see you again in the next session. Goodbye and happy investing.